Growers offers all types of policies, including basic yield policies that provide coverage based on harvested yield per acre, and revenue policies with both upside and downside price protection. Cost depends on the crop, policy, and your location. That's why our crop insurance agents help you price out the best options and coverage level for your business. Crop Growers through Farm Credit is here to help you weather your financial ups and downs, no matter what crops up. Learn more at cropgrowers.com.
So welcome to another one of our Fireside Chats. My name is Casey Havicus. I'm one of the Dairy Management Specialists on the North Country Regional Ag Team. And today we are joined with Anup Singh, who is an advisor with Solera Advisors. So Anup, I will pass it over to you if you would like to introduce yourself a little bit further and kick us off tonight.
Well, thank you, Casey, for having me on this podcast and this show. It's very fulfilling that people like me can be of service to the farm community, because in some shape or form, we make our living from the farm community. So thank you for having me. I think some of you may be familiar with me, but I spent half my career, my first half of my life-to-date career in energy, until I met my beautiful wife 10 years ago in Houston, because that's where all the energy people live, in Houston. And her father is a 6th-generation dairy farmer in the Northeast. And that's how really I got interested in the dairy market. And although initially nobody would give me a job in dairy, so it took me a little while. I spent 5 years in Asia working palm oil and ag markets, and then I moved back to the States to work in dairy. So that's my background. What we're going to do today is we'll spend a little time delving in the past, because the past is a great place to start to understand where the present came from, and then we'll move into the present and then the future. What's also interesting about, not interesting actually, what's very, very instructive about the most recent past, meaning the pandemic and significant change in lifestyles and things like that, is this condition has done two things. One that is explicit and one that is implicit. The explicit part, of course, has challenged supply chains, businesses, has exposed vulnerabilities, and has exposed where there are risks, gaps, stress points, all the above. That's the explicit part, which I think is easy. Well, I don't think it's easy, but it's at least in front of us, and we can sort of look at that and derive conclusions out of it. But there's also an implicit part, which has been the more difficult one. Is I've observed this for myself and my core clients, is that explicit stress and change and disruption has also exposed how we as humans, individuals, will react to a situation like that. And how, when we see things change, prices move around, our own behavior. Because this kind of volatility in the markets, at least in the dairy markets, we have not seen in quite a while. And when these prices move around, it has tested the financial and emotional fortitude of everybody in the market as well. And I'm hoping that as we reflect and think about how we have behaved in the last 8 to 9 months, we'll get insights into our own behavior and our ability to respond and react to the markets. So hence, we'll take a short history tour, and then we'll get into the present. So in terms of history, in addition to studying in dairy very intensely, I also look at broad commodity markets. When I say broad, I look at different cross-section of commodities to get clues and get ideas on what are other businesses, other markets doing in a similar situation. So we'll start with coffee. So coffee is an interesting commodity. It's a very internationally mobile commodity. And in the recent times, meaning in this pandemic period, has been very instructive because coffee, I mean, you think about it, 60% of coffee is consumed socially. So, when I was not stuck at home, I would consume maybe 5 or 6 cups of coffee, of which 4 were networking, social, business, meeting type coffee at home. I just have 2 coffees in the morning. And if you think about that globally, well, coffee and butter are very similar. There's significant food service demand. So this is coffee. And what you're seeing here is this is the last year of coffee. As you can see, I put the dates on. And just to give you a sense, this insert here is the last 10 years of coffee. So this is December, when none of us knew there was a pandemic going on. And this screeching up in price, although in grand scheme of things, the coffee price is still on the lower quartile of the 10-year price. But if you look at just this microsystem, this is holiday demand, Chinese New Year demand, European demand. It's just a great demand story unfolding until, all the close downs happen and coffee comes down crashing. Now, these 2 green lines is basically cost of production. So coffee came down below cost of production. And then you have seen these spikes. So Feb, March, June down, October down. And we'll get to understanding what these peaks and troughs, how do they instruct us? But let's just keep that in mind. So this is coffee. Next one, cocoa. Now, cocoa is an interesting ingredient as well. Coffee is food service. Cocoa is a retail ingredient. Most of the cocoa that is consumed goes into products that we buy in the grocery stores. So cocoa retail, it's not the same as cheese, but it's pretty similar. Maybe not for North America, but for other parts of the world, a lot of cocoa is consumed in retail ingredients. There's another interesting thing about cocoa. In Southeast Asia and Asian context, cocoa, so when you eat cookies in the grocery stores, when I was growing up in India, and even now, cheap cookies don't have cocoa in it. I don't know what they have in it. It tastes like cocoa, but what I learned later on is it doesn't have cocoa in it. The expensive cookies have cocoa in it. So cocoa actually also tells us what's the state, or broadly, what's the state and affordability of consumers globally. There was a comment that somebody had made to me 5 years ago that the price of cocoa is a good barometer check of GDP, especially CPI, and how consumers, if they have money or not, because they will consume more cocoa products or less cocoa products. Now, there's a grain of salt in there, is the way the companies that take cocoa, put it into the ingredients and sell it, they can always reduce the percentage of cocoa if cocoa becomes expensive. So there's some lost in translation on that, but by and large. So you see, same thing, December through Feb, screaming increase and a massive downfall, July low, Sept high, August low, Nov high. Now, different to coffee, this is sort of in the top 1/3 of the prices. So that's cocoa. Coffee, food service, cocoa, retail. Palm oil. So palm oil is a good barometer of Asian food service demand. Palm oil needs a little bit more work, and then it is used in all industrial food service cooking. So July, Jan, and then May was the lowest. And since then, look at this rise, Sep, Nov. So this is basically a proxy for Asia reopening, economies returning to mobility, or at least demand coming back. Now, this rise from May through November has two festive demands as well, India and then also now China. But these countries are in relatively low mobility part as well. But there's clearly a reconstruction in prices. So that's palm oil food service. This is dalian soybean meal. So soybean meal is traded in Chicago. There's also a soybean meal contract in the dalian futures exchange in China. I used to trade this when I was in Singapore because we used to manage 2 crushing plants in China. And so this is, and I say China meat, the primary use of soybean meal in China is for their pork herd. The pork herd was suffering from African swine flu, but it sounds like it feels like there's some reconstruction of that herd going on, and you see that in the soybean meal prices in China locally. And this sort of also looks like soybean meal in Chicago, which everybody in the farm community here is very familiar with. So Jan, May, July, Sep, Nov, very similar to the palm oil chart here. This is soybean. This is something we all are very intimately familiar with. And soybean, it tested 1200 in 2016. It tested 1200 again. Corn, 440 is basically a long-term price test. Now, what's interesting about studying these price levels is they're not necessarily very, you can't, or I don't use them as predictively as I use them as emotional indicators, because in these markets, market is a function of a buyer and a seller. So prices stop going up because market runs out of buyers because things become too expensive. Prices stop going down because market runs out of sellers because the price is too cheap. So there's clearly some affinity to these numbers. Also, you see, on the buying side, there is a commercial budget. Everybody has annual budgets. Now, they can go above and below the budget, but there are budgets. On the other side of the budget is your and my affordability to buy these products. So if the manufacturer starts to pass the cost of the raw material down to us, we may change our behavior. You see that now, it's not food, but when you see gasoline prices and diesel prices, it very quickly changes consumer behavior. I don't think that transmission happens in food as quickly, but whenever it does, you will see a nearby reduction in demand, and that changes buying and selling behavior. Anyway, so as I said, this is where we are coming from. Now, oh yeah, I forgot. This is U.S. gasoline. So it looks like there's a return in passenger mobility. These were the prices up until Jan. April, we tested the low 50 cents a gallon. Now, 50 cents a gallon, we were not buying it at the chains and at 50 cents a gallon. This is wholesale. But I think I've filled up gas in my car here in Chicago, I think at $1.10 in the middle of the summer. But that price is now doubled since April. And now these prices respond to demand and things moving. So of course, supply is a big part of it, but nevertheless, this to me is a sign that mobility is returning. So where do we go from here? Now, I hope nobody on this call, nobody in this country, nobody on the planet doubts that there is life on the other side of this really crappy pandemic. And I definitely believe in that. And my view is that mobility will return. In fact, I was the opinion that mobility will return back when cheese did $1 in the month of March and April. And my thing was, well, how low can it go? And the worst has happened. Everything is good from here. just a matter of, how long does it take. Now, so I still feel that it's not a matter of if at all, it's a matter of when. So what you're seeing in this chart here is the TSA, the guys who want us down in the airports. So this is the TSA scans, and that's probably the most real-time free data that you can get on the internet these days. And they have data as recent as yesterday. So these blue dots flying in the air, hopefully, I hope we were one of those numbers flying now. So this blue dots flying are from last year, 2019. These bars is this year's flying. And this red is a proxy for recovery. So we are far from recovery, but we're not zero either. This was 2% or 3% of the lowest point in April. We are now at about 30%. Holidays. So this was Thanksgiving, this was Memorial Day, and this was July 4th. And these are all at the 40% ranges. So what this is telling us is that, somewhere here, people were absolutely scared to travel. Well, that is coming back. Now, most of this travel, I think, is discretionary travel, meaning people traveling, not businesses getting people to travel. But if this is happening, the more this happens as individuals, we will get more open to the idea of flying, feel more secure. I've taken 2 flights in the pandemic, and I would do not take this as an advice. Please do your own homework before you get on a plane. And all that caveat, all that disclaimer aside, I will say the safest time to fly is now. The planes are so clean. My wife got on the plane and she said, "This is a new plane." Like, no, the plane is not new. It has been cleaned for the first time. You've just never sat on a clean plane. Well, this is what it looks like. Anyway, I think the planes are very safe, and I think it's fascinating. Anyway, but mumbo jumbo aside, what I really mean to say is that mobility returning is not a matter of if, it's just a matter of when. And what this actually tells us is what is the state of return to normalcy, what is the state of return of demand, what's the state of return of business as we knew it, which impacts all of us on the farm, producing milk, shipping the milk to the co-ops, co-ops taking the milk, converting them to commodities, and marketing them. So what changed and what is changing? Now, there's a lot on this chart, so we'll just start from the top and work our way down. So on the top is, before the pandemic, we had hectic lifestyles. We were consuming all sorts of products at grocery stores, at food services. People were going out, we were going to ball games. Life was wonderful. And there was a ton of demand. In fact, there was a lot of investments made in increasing the capacity of cheese manufacturing here in the States in response to that significant amount of demand and great economy and good jobs. So we had a hectic lifestyle. And then there was a dramatic change in lifestyle, and that changed not in how much we consumed, but what we consumed and where we consumed. So the top line is essentially the consumer, us. And I don't think we have adjusted to the new normal because we don't know what the new normal is. So that phase hasn't happened yet. We sort of, in this red bubble, desperately trying to come out of it. That's the state we're in. Now, what does that do from a business environment? So business environment, when that transition of hectic lifestyle to completely lockdown happened, there was a massive level of abnormality. It was not normal. And that abnormality then transitioned to uncertainty, to demand uncertainty. And I hope now we are transitioning to, if there is a term called regular uncertainty, we're sort of somewhere in that transition phase. So what does that do to how buyers and consumers and buyers in the market of dairy commodities, not just dairy, any commodities, how do they behave? So you think about it, let's just say the first, this drum reflects the stocks that companies would keep. And what I mean by that is, if you run a cut and wrap business, you need to have cheese coming in at a constant flow rate. So you can cut it, wrap it, age it if you need to, get it to the distribution centers and get it to the retail. Roughly anywhere from 30-day to 65 to 90-day supply chain. So you have to keep the inventories at each of these transition points stocked. And it is that stocking and restocking of inventory that keeps the entire supply chain moving, keeps milk from the farm to the cheese vat, to blocks or barrels, to processing, to retail, into our, into our cells. So that was the restocking part of it. Now, whenever these abnormality happens, the first thing that all the buyers are told is stop restocking until we know what's going on. And then demand continues because we still have to eat. So that sort of starts drawing down these stocks at individual companies. And then they're instructed, use what you have. Let's just see how it plays out. And then it goes to, from there, to reorder just the bare minimums. Now, what that's doing in all this behavior is that when the buyer is doing a reordering of the minimum, well, guess what? My buyer, so let's say I'm the seller, and there's the buyer on the other side. The buyer on the other side, until 4 months ago, used to buy a month, 2 months, 3 months of supply at a time. Now it's just buying a week or 2 weeks of supply at a time. What is that doing to my business as a seller? It is making my inventory very burdensome on me. And my boss is telling me, can you get rid of this inventory really fast? So what do? I drop the price. And sort of that becomes a self-fulfilling prophecy. Although that's not how it played out in the cheese market. But this is how that entire consumer chain actually operates. Reorder the minimum. Now, a big part of mobility returning is resumption of consumption in forms that people had seen in the past. So what does the buyer need to do? They have to start restocking this inventory. They restock inventory, more buying happens, prices firm up, and that cycle continues. So we're sort of going through this, changed and changing thing. I would argue that while mobility will return, while life as we knew it to a great extent would come back, I think there are certain permanent changes or semi-permanent changes, positive changes, that I don't think are going to change. For instance, anybody who can flexibly work from home, who had long commutes, will probably not go back to commuting as much. Now, one thing I talk to my clients around the world, and a common theme from, and I work primarily with dairy companies, what we are seeing both in Europe and Asia, more Europe than Asia, is that, and the person was laughing as he was saying this, because like, don't take it otherwise. He says, the slower pace of life, meaning we're not getting on the trains and running to offices anymore, is good for dairy. Now, so when the resumption of consumption happens, I think it is still good for dairy. It's just going to go through a rough patch. And the rough patch will be when this reconfiguration of buying behavior, supply chain changes happens one more time. But this is what has changed, and this is what is changing. So what is not changed? Well, what hasn't changed is consumption. We still have to eat. We still have to consume calories. We still have to nourish, and we need nutrition. None of that has changed. So the form in which we consume food and how food is served to us, I think that's probably a few more reconfigs yet to go on that one. But that hasn't changed. So what does that leave us to? Well, we saw some really crazy volatility. So this is 10 years of cheese chart. This at the end here is all 2020. 210 to 115 to 250 to 164 to 250 to 164 again. Now, you can look at this and it's really scary. What I've been trained to look at this and basically say is that, volatility allows us, or as my boss taught me, volatility is where you wash your sins. Meaning, if there are things that you didn't get done previously, volatility will give you opportunity to address that. And the key message here is apportioning. As you can see, I wrote a bunch of sell some more, sell some more, sell some more. Part of it is communicating that as much as I would like to say that, people in my role who study this for a living, have some, we can look at this and maybe know slightly more than the untrained eye. The truth of the matter is we don't, because I don't think anybody predicted that there was going to be a pandemic. And let's move one step beyond that point is, I don't think anybody predicted that there would be this level of volatility. So I don't think we know. What we do know is that the markets have their way of solving problems. And what are the kind of problems that the price actually solves? If there's too much inventory, the price solves that problem by going down. If the buyer is not getting what the buyer wants, price solves it because the buyer becomes willing to pay more, and the price goes up until somebody who was not willing to sell becomes willing to sell. So the price solves these problems. And the way we solve our risk management problem, at least on the farm and people with production, is we apportion, and when the market gives us opportunities, we take some of the opportunity. The idea is to do it in small sizes so you don't regret it as much. One of my mentors who works with me, he's a partner with me in my business. He's in his, I'm going to age Don now. Don's in his late 60s, mid 60s. I met his mentor several years ago, and he's his soul rest in peace. He's passed away, and he had taught Don, who taught me, that all decisions are wrong. You either do too little or you do too much. The maturity is how you learn to live with it. And the way we have learned how to live with this is to do it in small sizes so we don't regret. If it works for us, we do more. If it works even more, we do even more. And if it stops working, guess what? We stop doing it until the market comes back and gives us the opportunity to do it. So that's really the lesson here, is that I don't think any one of us can predict where it's going to go. All what we can do is find ways to apportion the size in which we manage risk using forward contracting. So how do we, tackle the forward contracting problem? I don't know. In the Northeast, in Houston, we used to call this knowing your uncle point. And the way I was taught about the uncle point is that you call uncle when you can't take the pain anymore. And in the markets, we were told, well, know your uncle points. Now, what you see here, the chart is of class 3. And the way we study class 3 is these blue squigglies all over are the forward 12 contracts. The dark blue line is an average of the front 12 contracts, or a 1-year long strip, if you will. And this red line is a long run average of this 12-month strip. Really, there's nothing predictive about it. It just allows you to get some context into what is going on. And every business will have their own, but we need to determine what our low regret sell levels are. That you sell it, and if the price goes higher than that, you will not regret it. There's never a no regret level, so I won't even, it's just not pragmatic to have a no regret level. But as I think we can find it in ourselves to find a low regret sell point. So the first task looking forward for next year, I would say, is, and that's where I would connect what I was saying initially, is the implicit part is we have seen in the last 9 months individually, I don't mean, macro or, what other people are doing, just in ourselves. We have actually learned a little bit about ourselves through this massive change in markets, in prices. A few of us felt that we'd go bankrupt, and somehow we scraped it through. So it has exposed our edges. It's exposed how we behave at the edges. So I would say through these trying times, we come out knowing things about ourselves that maybe we did not know about ourselves before this. So take all of that, combine it, and determine now, what do you think are your low regret points? So low regret points are for the upside price, and uncle points is what levels do you think at which points you will hurt? And these two levels are basically giving us, and there is no scientific way to do that. I mean, your financial advisors can get scientific and come up and give you some numbers, but in the end, you have to live with it. So it's a matter of each business will have their own. And when the market gives you opportunities at these low regret sell points, take some. And if you find yourself not hedging at those levels, well, you may need some more work to do to find your low regret levels. So find your low regret levels, find your uncle points. And I think if anything we have learned is volatility gives us opportunities to get done that we didn't get done earlier. And portion size. Last, we'll cover this, is this is an exercise that I do it with my clients, and it helps us size. So what we will do is basically look at there's nothing about the future we know, all we know is what has happened. So so how we learn from what has happened is we say, well, short range, mid range, long range. Past 3 to 6 months, past 18 to 24 months, past 36 to 60 months. And you compare current price to whatever this average was across these terms. And you will get a sense of, is the price high? Is it medium? Is it low? And in this period, has the price trended up, sideways, or trending down? And once you do this exercise, looking at the price, answer on how much to buy and how much to sell at what portion becomes very, very clear. That's all I had prepared.
Great, thank you, Anup. So this is Nicole, everyone. I know we have a few extension educators on this evening. Does anyone have any questions for Anup? Comments?
I thought it was really interesting, Anup. Thank you very much.
My pleasure.
It's a lot to take in.
Yeah, I would say that the last 6-9 months have, in general, been a lot to take in.
So Anup, I have a question.
Yes.
If a dairyman has yet to kind of foray into forward contracting, and they're looking for an advisor, what are a few things they should look for when talking to someone to find someone that's going to work for them, to work with them? Because, a lot of people are a little bit nervous when they say, maybe you should go and speak with an advisor, and they say, well, we don't really know who to contact. Or what are some points that folks should be looking for to find an advisor that they can work with and that they feel comfortable with?
Very good question. And it is not an easy answer. And the reason it's not an easy answer is that so I grew up in India, and in India, what they say is, India is still a very, you have, wealthy people have servants at home and things like that. So a lot of, employment that happens in families and homes and things. And what they would say is, when you hire a watchman, you don't hire a watchman, you just meet the person and hire him. You have to get to know the person has to get to know you. And there's a relationship that's developed, and over a period of time, this evolves. So there's an element of trying and trials to be done in finding the right advisor for you. Advisor has to be somebody who your personality, your risk tolerance, how conservative you are, how aggressive you are, and the advisor need to gel. And part of that is not expecting results. And what I mean, and I'll explain what results actually mean, but then there has to be a trial period. And I think understanding that trial period and going into that relationship with that trial period construct in mind is, I think, is prudent. When I start working with my clients, I tell them that the first year is going to be you getting to know me and me getting to know you, and we learning each other's buttons. You see, it's very different in working with a dairyman or a family-run business than it is working with corporates. Because corporates, there's a level of abstraction. You are actually dealing with a balance sheet and an earnings per share, or things like that. In this business, you're actually working with somebody's family. So the advisor needs to treat you like a wealth management client. The way I think about this is earnings in excess of cost is wealth, and preserving wealth at the farm level. I mean, that's the philosophical, I would say, foundation. If that foundation works, then I think the relationship is more longer term. And what I mean by results, delivering results is concerned, there is a financial mathematical, hey, this is your break-even price, you should do this, and this is your da-da-da, you should do that. I think that's one element of it. And there are some people who are extremely good at it. Then there's a second element of it, which is this, what I call wealth management type relationship, which is your job as an advisor is to stand by your client at the most difficult times, because they haven't seen this. You might have seen it. And you are the only person who know how this thing, well, you don't know how this ends, but you definitely know how this sort of plays out. And that is a relationship part of it. And there has to be some deep level of trust. So that takes time. I would say, the answer to the advisor is that it is not instant. It's a six months to a year is what it will take to establish that working relationship. I know it's not an easy answer, I don't think.
No, but it's a very good answer, and thank you very much for that. Like I said, most folks get a little tenuous when talking about risk management, especially if they're unfamiliar with that territory and how the mechanics of the futures markets work. It can be very confusing. So when they have somebody that they can trust with their money, it's very, very important. So thank you for that question or that answer.
My pleasure. So actually, I would like to ask you the question, and maybe we can have a dialogue based on that. The few minutes that we have left is what, now I think March, April was a very difficult time because the prices basically just crashed. And I know, working with some of the banks and other entities, there were a lot of nervous dairy families, at least in the April-May timeframe. How have you sensed these sentiment and feeling, and how farms are getting, I mean, the price, given all of this, milk price has actually not been super bad. It hasn't been $13.50, right? Which is what I was thinking. If this thing continues really bad, that is what we might see for a while. But it hasn't been $13.50. But having said that, what kind of vibes or what have you been picking up in the relationship that you guys have?
I have gotten both sides of the spectrum. I can't really say that it's very clear, and I can let my other extension partners kind of talk about that, because they may have some more insight with other farms that they've spoke to. But folks that I've talked to, they're very different. It's all across the spectrum. So I have folks that are very happy, and I have folks that are still crying about it. So,
Right.
And a lot of that has to do with their cost of production and
Sure.
Trying to whittle that down and become more efficient. So it does run the spectrum, unfortunately.
Right.
Yeah,
Does
I
anyone
would say, well, a lot of the farms that I've had conversations with have, said that things are better, and, they're not necessarily completely happy, but things are looking up. And then some farms that things are still not looking so good.
Right. Well, what's also, Nicole, when you and I were chatting during our prep, is that, on the farm, we have several market forces that converge. We have the milk price, we have the feed price, we have fuel, we have electricity. And I would say that there's volatility in all the four, and scanning the market for opportunities across all of those four, helps. Every $1,000 you save helps.
So how should folks go forward with that nugget of knowledge, Anup? So should they look at one thing in particular? I think that's what I would do, but you just gave 4 different things that they could look at, or should they be focusing on one thing just to kind of get a handle on pricing? I mean, how should they look forward in the next 3 months, 6 months, 9 months, 12 months, if we're looking at it quarterly going into 2021?
Right. So, the most obvious thing is, of course, milk price, because that's the income check, which I think gets a lot of attention. So I think people look at that every day anyway. But look at meal, right? And corn. Meal's up 140% from, remember on the farm buying it at 300 and it's 380. And corn, was 290, 300, it's 440 or 420, whatever. It's up. It's more than 4. It's more than 400. So just things like that. There's a lot of opportunity, for it. There's going to be a lot of weather stories this year for bean and corn. South America, some moisture, but those stories and prices, we need to look at both of them at the same time. People saying, we call it in the business, watching the tape. Of course, farmers don't have time to watch the tape, but I would say, given what we have gone through, make 30 minutes a week and look at all the prices and see where the price was and where the price is. We were calling up brokers, a couple of months ago to get pricing on diesel because diesel was cheap, right? Right before the reopening story happened, and diesel's now, crept back up. On the farms that I work with, we had forward contracted diesel last year, $220. Market's now at $160. That's a few $1,000s of saving. So what we are encouraging our clients is, make 30 minutes a week. Sometimes that's all what you need is 30 minutes, because you see, there's a bunch of noise in the market. Prices go up and down every day, like 5 times. Will not change your balance sheet. But if you make 30 minutes a week and look at these prices, and the homework to be done is to know your uncle points and no regret levels. I think that's the homework that probably needs the most amount of attention. And as I'm saying this, what I'm also remembering is that when we used to go to conference, I didn't like going to conferences. Not a very social individual. But when I would go to conferences, people would ask me questions as, "Hey, what's your price forecast?" And initially, when I started off with the business, I would naively go and volunteer my price forecast. And then finally, when I got the maturity, I started to think about it, and I said, well, you probably asked 30 people where the market's going. And as I was saying, none of us have a crystal ball. So any number I give you will be somewhere in all the numbers you've heard. So it's not really the price forecast that's relevant. What's relevant is, do you know what you will do when the price goes to a certain level? So the key question is, okay, so class 3 price now is, it's not 20s anymore. It's 16.50, 17. I think I saw some 17s today. Sits at 17. Do we know what we will do when the price goes to 17.50? And do we know what we will do if the price goes to 18 bucks? And I think knowing that, perhaps even writing it down, is your no regret levels, is a great start. Same is the case with soybean meal, meal, corn, whatever you buy, is, write down what price levels will you be buyers, and at what price levels will you not be buyers, and write down what you would do for diesel as well. And I think that goes a long way. It sounds like a very simple exercise, and it sounds like, yeah, everybody does it, but actually most people don't. And you'd be surprised what you can get out of that exercise. Make 30 minutes a week. Maybe make an hour a week to write these things down, and then make 30 minutes a week to review the markets as you see this, and forward contracting. It made a big difference. One of my clients, they signed up for DRP. Now, I have a lot of peeves with the DRP program, but one thing I really love about the DRP program, like absolutely passionately love about the DRP program, is that you can do any size. So really, you could buy, if the price is right, 200,000 pounds worth of insurance a week. And you could keep layering those trips in. What that also does is, gets you to look at the markets. Not last year, actually this year, January, 16.50 was 8 cents. And today, I think, Nicole, you and I were chatting about it, right? I think 15.50 was 35, 40 cents.
Yes, I think so.
And that's what the scanning actually does, is actually tells you where the temperature is and also helps you test it. So it's a little bit of work, but I'm sure we can make 30 minutes a week for doing that.
Mm-hmm. That is a great knowledge tool. Thank you so much, because you're right. Folks usually don't look at those, and they kind of get caught. So, yeah. I know that we talked yesterday, the protein is just so high right now. And because some folks have done their homework, they're okay with giving up some pounds of milk because of protein, and kind of changing some things around. So no, I think you're spot on with what your thought process is, and trying to get folks to really think about the inputs in their dairy for the output of milk and their cost of production.
Yeah.
So go ahead, Casey. Sorry.
Oh, I was just going to say, we have about 10 minutes left. So I was going to see if Betsy or Alicia have any questions for Anup before we wrap up.
No, but I'm still confused about how you how you actually do forward contracting. What are the mechanics of it?
Meaning, how do you sign up for forward contracting?
Yes.
Or how? Oh, okay. Well, I'm sure the extension can help you with that. But there are a couple of alternatives. There are programs offered by the USDA, so DRP program or the LGM are some examples of that. Your co-op might have a forward contracting program as well. So those are the avenues, Betsy, to explore. If you depending on what kind of bank is your farm's banker, your banker might have some alternatives as well. Forward contracting, really what we're saying is some way for you to get some assurance for your milk price.
Right.
So, you don't have to go trade the futures. In fact, I would say don't do it. Not if you've not done it before, and just don't do it. Even I would not do it. But look at some of these forward contracting programs, especially where you don't have to put a collateral down. A lot of the USDA programs, you don't need to put your collateral down. There is no cash flow impact on you until things happen. So talk to your banker, talk to your co-op, and see what alternatives they might have for you.
Okay, that makes sense. Thanks.
My pleasure.
Alicia, do you have any questions?
I think you kind of already answered this, but I guess if maybe you want to speak about what advice you would give to farms that are maybe currently considering selling their operation, like looking at these trends, what you might suggest to them.
That's a very personal and difficult question to answer, because I would not know what the motivation is to sell or get out of that business, or how, what's the size and nature of that business and things like that. The very, 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 and this answer is, Alicia, I would say, in the grand scheme of things, this answer is going to be useless, but I'll give it anyway, is at the macro level, so I had a very lucrative career in energy, and then I had an even more lucrative career in palm oil. In the last 5 years, I'm sitting in dairy. And the reason I'm in dairy is because my brain went through an exercise of understanding what is happening. And what I mean by that is, you see, I'm an engineer. As engineers, we design machines that do more with less fuel, meaning we consume less calories. Machines do. Machines consume less calories. Humans are the 100% opposite. Nobody talks about consuming less calories. And the number of humans is only growing. So the demand for nutrition and demand for calorific, tonnage, edible calories is only growing. And milk is the only thing that goes inside us. And we all have this eternal faith on consuming milk. And that's why I switched my careers and I'm in this market. Because, there is an entire tsunami of people, in Asia, in Africa. I'll give you some interesting, ways that I have, thought about this is, in the next 5 to 7 years, we are going to add 350 million people population to this planet, which is roughly the size of US and Mexico put together. And that US and Mexico is going to show up in Southeast Asia, not China, Southeast Asia and Africa. And they have absolutely no ability to scale their milk production to feed that group of people. Where is that opportunity going to come from? Well, that's going to come from us, right? We produce milk here. We produce milk in Europe. And the Kiwis produce milk. I spent 2 years in New Zealand. And, there's finite land. They can't produce any more milk, maybe a little bit more. But that's about it. So that's how I think about this, is that if you have a way to endure, and I know it's very difficult. I'm married into a farm family. When I was living in Vermont, I'd have dinner, every weekend, but then spend a lot of time. I spend a lot of time with my brother-in-law and my father-in-law talking markets and farm balance sheets. Is not easy. None of it is easy, but it is not a dying business. If anything, I think we haven't even seen the awakening of this business just as yet. And I'm an eternal optimist, and you would even call it irresponsible speculator when it comes to the dairy market on the upside.
I think that's really interesting. I think we all know that it's been a super tough year for farms, and it's kind of nice to hear a different perspective and a positive perspective on, if we take a step back and think about what's happening and think about how important agriculture is. I think it's a really nice reminder for our farmers to hear and to recognize that it is a really important business and industry that
Absolutely.
we're in.
Nutrition. There's no better form of nutrition. And I'll say something controversial. I'm sure I'm going to regret it at some point. Is that this plant-based food and all this jazz is going on, and I think that takes a lot of newspaper, frontline and whatnot. In Turkey, they eat fake cheese, and there are many countries where they eat fake cheese because they can't afford real cheese. So there are people eating fake cheese. Well, they can eat real cheese as well, right? And there's things like that happen, and I'm like, well, I don't know why. I mean, we have to make through this time frame, but I think we'll be drinking milk and eating milk for a very, very generations to come. I don't think that's changed. That's my view.
Yeah, definitely. Nicole, do you have any concluding thoughts before we wrap up?
No, I think that Anup gave a lot of food for thought. I appreciate his time this evening. I know that, like I had said earlier, futures markets can be very, very confusing, and forward contracting, using that to better your business can be very confusing, but trying to find the right advisor, and Betsy was asking about that. I think trying to find the right advisor, if you're just dabbling in it, just reiterating what Anup said, talk to the folks at FSA, because you could get into the dairy DMC, you can get into dairy RP with a crop advisors. You can speak with them because they'll do both crops as well as the dairy RP or the
Correct.
LGM. So there are folks out there if you want to dabble, or you can look at doing hedging contracts with someone like Anup in an advisor types setting. So there's a lot of different ways to go through that process.
Very cool. Well, thanks for having me, and thanks for putting this thing together. This is a great service you guys do for the farm community, and thanks to you guys. I mean, it's not I will not say it's a thankless job, but somehow I feel it is thankless. But thank you very much for putting this thing together.
No, thank you. We really appreciate having you, and I think this will be really good information for farmers once we put the recording out there. So just before we wrap up, I'm going to steal the screen sharing privileges back.
Please do.
Wrap up with a really quick slide. Okay, so I just want to take a moment to thank our generous program sponsors. So we have several at the gold level and silver level that are listed here. And then next week, please feel free to join us for our Fireside Chat, which will be a discussion on dairy cattle reproductive management with Dr. Julio Giordano from Cornell University. It's at the same time and same place, so you can use the same Zoom link to get on, and we hope to see you all then. Thank you again, Anup. We really appreciate it, and thank you, listeners, for tuning in to another one of our Fireside Chat series.
Thank you,
very
Anup.
much. Thank you very much.
Thank you so much.
Bye-bye. My pleasure. Bye. Anytime.
Have a great night.
You
Good
too.
night.